I want to show you how it's possible to make extra income every month using a swing trading strategy that only takes about an hour a day of my time. This is the most passive form of trading I've found, and once you get the basics down, this is something I believe anybody interested in the markets can do. I'm always looking for different ways to generate passive income, and swing trading is one of the least time-consuming ways I've found to build wealth and boost my portfolio. As you can see, my account for 2023 is up a little over 80%. You can do this with a full-time job, kids, or whatever else you have going on in your life. You just got to make sure you put in the work up front so you know what you're doing and you don't end up blowing your account. If you're totally new to this, let's go over some basics real quick. So what do I mean when I say swing trading? Swing trading is either using technical or fundamental analysis to enter a position that lasts 2 days or more. Some of the positions I enter, I exit the next day. Some last a week, a month, or even longer. For me, this is great because I have a full-time job and I don't have to sit and watch the screens all day like I would for day trading. I can get home from work, put the kids to bed, scan for trades, and then enter them the next day. I say this takes about an hour a day, and I don't check the screens every day. Some days I might spend more than an hour. It really just depends on how much you want to trade and what your skill level is. If you're new to this, you might want to spend a little extra time learning strategies, technical analysis, risk management, and all the other things that you really should know before you start to risk your hard-earned money. So how I have my account structured is most of the value is held in longer-term stock positions, and my broker gives me about 100% margin, roughly. So on a $130,000 account, they'll give me anywhere between $100,000 and $130,000 in margin, which I use that money to enter the options positions or use as collateral. And my broker doesn't charge for collateral on margin interest, so that's very useful and is a way to generate a return on money that you're not even paying interest on. So at any given time, I'm maybe only using $5,000 to $50,000 in margin, and I'm not actually trading the full $130,000 account value. So why do I like to use options? Options gives you more leverage than if you're just going to trade the stock itself. This really means that you control a large amount of underlying stock with little capital. Also with options, there's a lot of different strategies that you can use to tailor to how the market or maybe an individual stock is trading at the time. There are a ton of different option strategies to trade out there, but I really recommend that you just start with a few until you get the hang of options and start to see some consistency. Options are a little bit more complicated than just trading the underlying stock. You got to worry about things like your expiration date, dividend dates depending on the strategy you're trading, your theta decay, and delta. A lot of new traders tend to buy options because they see on social media people posting quick gains of 1,000%, 2,000%. I just think over the long run, that's probably a losing game unless you have a proven strategy. I would try to sell options or trade strategies that don't get hit with theta decay so hard. When you're the buyer of options, you're paying a premium that will eventually deplete to zero if the price doesn't go anywhere and doesn't go anywhere quickly. But when you're the seller of options, you're collecting a premium that will eventually become all yours as long as the stock price doesn't go in the money. I don't just sell options, but I try to trade strategies that don't get hit with theta decay so hard, and they usually have a higher win rate. The main strategies that I used in 2023 were vertical spreads, covered calls, cash secured puts, and protective synthetic spreads. So how much money do you need to start out? I would say you could start with as little as $500, but I would try to start with at least a few $1,000s. And this is to keep your position sizing reasonable. Position sizing is a very important part of risk management because you don't know which trades are going to be winners and which ones are going to be losers. And if you take a bunch of large positions and something happens in the market, you might just get knocked out of the game. Let's say, for example, you start out with $10,000 and you're going to risk 5% per trade, which is going to be $500 of risk capital per trade. And over the course of the next week or two, you find 10 good trades and you enter all 10 of them. Now, something comes out in the market, some big report, CPI event, bad earnings, something that causes the market to gap down, and all 10 of your trades become losers. And this can definitely happen because it's happened to me before. Now, you just lost 50% of your starting capital. Just to get back to break even, you have to now make a 100% return. This is just one example of risk management and why it's so important. And until you're comfortable with this, I would highly suggest that you trade a paper account instead of putting your hard-earned money at risk. I currently only risk 1 to 2% per trade. So with a $130,000 account, that's roughly $1,300 to $2,600 per trade. And a lot of the strategies that I have calls for me to cut loss sooner than this, but usually these numbers will be the max loss of any trade that I enter. And I try to diversify my trades enough so in the event of a large move, I don't end up losing all of my trades at once. You know, some people that I talk to about trading think that they don't have enough money to get started to make any meaningful amount of money. And, you know, they'll say things like it takes money to make money. And that is just complete bullcrap. If you can't manage a small amount of money, then you can't manage and keep a large amount of money. When I started out, I only had a few $1,000s, but if you keep adding to your account and compounding it consistently, you'll be surprised how fast you can grow. So if you were to start with $10,000 and you were able to generate a 5% return per month, which is definitely possible, that would be 60% per year. And in the beginning of the video, you've seen that I generated 80% for 2023. After your first year, your account would be up to $16,000. Your second year in, you'd be up over $25,000, and so on. And just imagine if you were to add $100 or $500 a month to this. You can see how you can start to grow your account pretty fast. Now, I want to say that it's also easy to lose a ton of money if you're not committed to learning, making sure your strategy works, and managing your risk. All right, so now let's take a look at my nightly routine and how I would scan for trades and setups that I might want to enter the next day. All right, so I use Thinkorswim for my charting software, and I think that they're one of the best platforms out there. And real quick, just to get started, I'm on daily candles, and I just have moving averages, 200, 150, 50, 40 EMA, and 20 EMA. And what I'm doing is just scanning down through the market and kind of getting a feel. So over here on the left, I just have the main market components listed first, just because I like to look at them first to get a feel for the market, get context for the market. So the VIX is the volatility. You can see how the volatility's been. SPX is overall market. It's been on a very strong uptrend. The Qs, technology sector. The bonds, TNX, is a 10-year bond. That's been playing a big role this year, as you can see. China is on a very strong downtrend. And then I just have the heavy hitters, Apple, Netflix, Tesla, Amazon, Google, and I go down through these first, gauge the market. And if I see a trade in any of these big names, I prefer to trade them. They have better liquidity, usually have good premiums. And I will just keep going down through all these stocks, usually pretty quickly like this, until I see something that catches my eye. And as you can see, I have quite a big watch list built, and these are just stocks that I've come up with over the years that I want to pay attention to. There's more that are not in here, but you just can't have them all. Stocks that tend to have higher liquidity, that's pretty important when you're trading options. And at a quick glance, I just want to look at what the stock's doing. Is it in an uptrend, a downtrend? Is it consolidating? You can see right, the Russell 2000 has just been consolidating for a very long time, pretty much trading sideways. Let's look at Apple. As you can see, Apple's been on a pretty strong uptrend. I would consider this period here a short-term downtrend. But overall, Apple has been on a very strong uptrend. And as you can see, China has been on a downtrend for a long time. It is usually a higher probability setup to trade with the trend of the market. So at a quick glance, I'm looking for retracements to a moving average or area of support. Look at all these trades that would have worked out. And, you know, maybe this one, if you got in right here, probably would have got stopped out of that one. But that's one out of, 7 or 8 trades on Meta that would have worked out and would have been profitable. So here's another example on gold. And like I said, I'm just looking for support or resistance or a moving average that's been tested multiple times. You can see that this support has been tested. I believe that I entered a trade on that right there. And you can see that this resistance has been tested multiple times. And this is actually a trade that I have open right now. And I opened it on the rejection of that resistance right there on that bearish pin bar. Now, gold is on a short-term uptrend. So there is a chance that it does push up, and that will be a losing trade. But on this one, it's a chance I'm willing to take. I would say most of the time I'm mainly looking at technical analysis and price action of the stock, but I do also sometimes use fundamentals in my trade analysis, and I'll give an example of that a little bit later in the video of a trade that worked very well using technical and fundamental analysis. Once you start paying attention to the same stocks enough, you'll kind of start to notice similarities in how each stock almost has its own personality, and some tend to react to macro events or news events differently than others. Some tend to gap up or gap down a lot depending on news events or macro events. Them ones you might want to avoid because they could gap up above your stop or below your stop. And if a stock doesn't really respect its moving averages or have a very clear direction on price, then you might just want to avoid it until you get better at this. Like Philip Morris, you can see just keeps going way up above and below its moving averages. The moving averages crisscross, and it's just kind of hard to get a good read on this and set up a high probability trade. So once you identify a high probability setup, you need to decide on which strategy you want to use to execute the trade. So I just want to give you an example of a trade that I entered recently on Adobe. You could see this strong area of resistance, tested 1, 2, 3 times, a break, and then a retest. And right here on the retest is where I entered. And for this particular trade, I decided to go with a bull put spread, which is a vertical spread, which is simply selling a put below the current price and then buying another put to hedge the sold put. So this is my stop loss level right here. And as long as the price stays above this level before expiration, I will keep the full premium. So here's what that trade looks like in my broker. I opened the position on January 4th for a credit of $540, total of 5 contracts at an expiration of February 9th, and the trade is currently up $365. The 2 strike prices I chose were $545 and $540, and that is because this price was around a 25 delta when I entered the trade. And that's usually what I try to stick to with this strategy. So as long as price stays above this level by February 9th, I will keep the full $540. So why did I choose this strategy over buying just a straight call for say? This strategy tends to have anywhere between roughly 70 an 85% win rate. And I don't need to be so correct on the direction of the stock. It can go down a little bit, it can trade sideways, and it can go up, and I still make the full credit. The only thing that it can't do is touch my short strike, at which point I would close the trade for a loss. Now let's just say in this example that instead of selling a bull put spread, I just bought a straight call. Yes, right now the trade would definitely be up, probably a pretty good amount too, but you know, what if price didn't rebound like that? Or if it just traded sideways for a while? When am I going to take profit on this trade? Is it going to be at the consolidation point? Is it going to be up at this high? You know, once most people see this start to climb, they're going to think, oh, if I just keep holding on to it a little bit longer, you know, I'll make some more money. And then something happens and price just comes right back down to here. That premium that you paid for that call is going to eventually deplete out, as to where with a bull put spread, I am eventually collecting that premium even if price goes sideways or doesn't go anywhere. Another example where I used the bull put spread and it worked out pretty well was on Salesforce a couple months ago. So what I was seeing was a pretty strong uptrend on the stock, and I'm looking for a retracement to a strong support or a moving average, which we had right in this area. So we had price retrace down into the 200 moving average and appear to be supported. I think I entered the trade on that bullish pin bar there, placing my short strike somewhere there, long strike somewhere there. So as long as price didn't come down and touch this point, this trade were to be profitable. As you can see, price pretty much went straight up from there. And I actually exited this trade earlier than expiration for 80+% profit. Now let's take an example of a bear strategy that I entered that is called a bear call spread on XLE, which is the energy sector ETF. And what I'm looking for is a strong area of resistance. So you can see we have one up here. Very strong area. Every time price gets up there, it retraces back down. Now if we zoom into this a little bit more, I will show you where I entered the trade and why. So as you can see in my trading journal, I entered this trade on September 15th. And what I was seeing here was price came back up to this level of resistance. Had a bit of a doji candle there, and then you can see this large bearish candle, at which that was when I entered the trade. And my short strike was placed at 96. This would be a short call. This would be somewhere up here. And my long strike to cover is somewhere in there. And as you can see, I closed this trade early on October 2nd, which I think was either that candle or that candle, for a $576 profit. So these trades usually last anywhere between 25 and 35 to 40 days. But as you can see, if price cooperates, you can close out of them a lot sooner. So as you can see, these vertical spread strategies, when you're on the credit side of them, have a pretty high probability of winning because the price can go up a little bit, it can go sideways, can go down, and you're still profitable. As long as price doesn't come up high enough to touch your short strike, you should win the trade. So now I want to show you another strategy that can generate higher returns, although it does have a lower probability of winning. But if you suspect the price to make a quick move, then this is usually where I would deploy a strategy like this. And with this particular trade, the stock was SolarEdge. As you can see, since 2018, it's been on a very strong uptrend, ranged for a few years, and then ever since interest rates started rising, has just been getting destroyed. And this is because this is kind of an interest rate sensitive stock. So this is where I said earlier, I used mostly technical analysis, but I used a little bit of fundamental on this one that helped me out with the trade. So if we zoom into the more recent price action of this, you can see that price has been dropping down, gapping down on macro events and interest rates. And then it kind of just starts consolidating, trading sideways, trading up a little bit. And then on December 13th, you can see this massive bullish engulfing candle. I think this candle alone was like 10 or 11% price movement that day. And I believe this was due to the fact of Jerome Powell, the Fed chairman, speaking that day, basically sealing the deal on interest rate hikes being over. And that's actually the day I entered the trade, even though price had already ran up so much. And the strategy that I decided to deploy on this move, because I did expect price to keep jumping up, is called a synthetic spread with a protective put, or sometimes I call a bullish synthetic spread. So as you can see in my trading journal, I entered this trade on December 13th, which is this candle, and I closed it just the next day on the 14th, which is this candle. And to enter this synthetic spread with a protective put, I buy a call pretty much right at the money, then I sell a put, one strike below that, and then I buy a put, one strike below that. And this bought put protects this sold put, so I don't have to have all that collateral out there, and it protects me in case the share price were to plummet for any reason. And in just one day, this trade profited $2,284, which is nearly 280% return. So if I have a trade that goes in my favor that aggressively, I usually just close it instead of taking the risk. Yeah, if I would have let it go till that day to close it, it would have been like a $3,600 profit, but you just never know. It might have jumped up one day, and then one of the Fed presidents could have said something the next day that the market didn't like, and it would have went right back down. So if you have a really good profit on a trade like this, you know, for me, I want to close it. And as you can see, the expiration was only January 19th, which is, you know, more than a month to go, and in just one day it made that much. So it's just a better idea to close the trade at that point, in my opinion. So as you can see, I use Thinkorswim for all my charting and analysis, but once I identify a setup that I want to take, I actually use Robinhood to execute the trade. And I know some people have problems with Robinhood and they got some slack in the past, but for me, it's just extremely simple. And the phone app looks just like the desktop version. So when I identify a trade the night before and I want to place one the next day, I might be at work and I might have to do it on my phone quickly. Now, I have had some money in Thinkorswim and traded around in there a little bit. I thought the platform was great. I use Robinhood for now. That's just a system that works for me. And I also have probably 3 or 4 other brokers, and I think they're all great. So you can just play around, pick a broker that you like. It doesn't really matter who you use. But if you're a beginner, I will say that Robinhood is very simple to use and it's very clean looking. Now, not every trade is a winner. You will have losers, and that's why risk management is so important. You can see winner, winner, loser, loser, winner, winner, loser. And, sometimes you have some big mistakes. This one right here was a big mistake. I didn't cut loss when I needed to cut loss, and I paid the price for it. But overall, with a good risk management plan, you can still be profitable. As you can see, for 2023, my win rate is 67.10%, which I'm actually very proud of. You might look at that and say, wow, you only win 67% of the time. But once you start learning more about trading, you'll find out that that is actually a pretty high win rate depending on what strategies you're using. And this is across all my strategies. It's just an average. And to be honest, in 2023, I still made a ton of mistakes, and I'm hoping to improve that in 2024 and do better. And the way to improve is by journaling your trades. I can't stress how important it is in journaling. When I started to journal my trades, that was the turning point in my trading. I mean, you got to analyze the data. You got to see what you're doing wrong, what you're doing right. And you're going to go back in some of your trades and look at them and just think, what the heck was I thinking when I entered this? And this one on Boeing was one of them trades. And all you can do is learn from it and move on to the next trade and just keep compiling data so you can minimize the mistakes you make, learn to control your emotions, and come up with a good risk management program. And that's all you can really do, is just learn from your mistakes and move on. If you're totally new to this, just like with anything else, you should be putting in more than an hour a day to get started. There's a ton to learn as far as different strategies, when to use them, risk management, trading psychology, and it's very easy if you just jump into this head first to blow your account. I've been there, I've done it. My first couple years of trading were a nightmare. I got into positions that were just silly to be in. I didn't cut loss when I needed to cut loss. I over leveraged and I lost a ton of money. So I do believe that you can avoid this if you practice, maybe trade a paper account, and just have a deep understanding of how this all works before you jump into it and risk your hard-earned money. This is just a brief overview of my whole swing trading strategy and how I'm able to do this with a full-time job and generate extra income on the side. So if you want to see maybe a breakdown of more trades, trade examples, more in-depth analysis of my strategies or risk management or so on, let me know in the comments. So if you want to see more, please consider giving the channel a like and subscribing.